Please welcome our esteemed guest, Eliza Owen, the Head of Residential Research Australia at CoreLogic. With a wealth of experience in property data analysis and reporting, Eliza has taken key roles at Residex, Domain Group, and CoreLogic. She's a passionate economist and renowned as a keynote speaker, captivating audiences across Australia with her insights in real estate and finance. Join us as we delve into the world of residential property research with Eliza Owen. Thank you for joining us on the show today.
Hey, Dom, thank you for having me. Great to be here.
It's been a little while. Last time I caught up with Tim, it feels like the whole market has changed. We were talking about it potentially being the eye of the storm or the bottom of the market, and it rebounding. Now, we've seen 3 positive months of price growth. I don't want to say 4, but I know you guys don't count that first January neutral month. What are you seeing in the market? Do you feel like it's the eye of the storm, or have we come out of the bottom of the market?
I think it's fair to say, given we've seen 3 consecutive calendar months of growth, as well as increasingly data flows like the auction clearance rate, selling times, and vendor discounting showing better selling conditions, it's safe to say that we've moved through the bottom of the market. That leaves the downswing period from May 2022 to February this year, peak to trough decline of 9.1%, and the market's picked up 2.3% from that recent low. So all in all, we're still about 7% below the high in April of last year, but certainly selling conditions and prices have lifted.
And I don't want to keep on harping on about this, but do you see any, are there any conditions in the market that tell you that there's still some fear, or there's still some uncertainty around that fixed rate cliff? Maybe a few consecutive rate rises will, pull the steam out of the market?
Yeah, this is a really good question. And I think on the interest rate space, it's changing with each piece of fresh economic data that we get. For a while there, after we saw the lift in May, all of this subsequent economic data was pointing to some softening. So things like consumer sentiment, retail sales, even the unemployment rate, which had started to lift. But then even just last week, getting the monthly CPI figures, which did show a bit of a lift in the annual inflation figure of 6.8%. So that is a kind of fresh concern, I guess, that has a lot of the major forecasters reevaluating where the cash rate is going to end up. We've seen a few of the major banks upwardly revise the peak for the underlying cash rate. So that is probably going to be the biggest determinant of the short-term trajectory in the housing market. And within that, you do have that ingrained risk of fixed rate mortgage transitions. By now, we're well into large volumes of transitioning from those fixed rate facilities. And over the course of the calendar year, it's estimated that 880,000 of those facilities are expiring. Anecdotally, however, I'm not hearing much about forced sales, maybe a little bit of an uptick with mortgage professionals and real estate agents seeing 1 or 2 events where there is a motivated sale or a forced sale off the back of people not being able to afford their mortgage. But broadly, when you look at the data, we're seeing very contained levels of listings. We're seeing very low levels of arrears payments in APRA's banking data. So it seems like that risk is pretty well contained at this stage. So the other element, I guess, to keep in mind is the longer term, which is the fundamental supply and demand conditions. We're not seeing a lot of supply come to market, but we are seeing a surge in ongoing demand from the strong inflation of net overseas migration in Australia.
That's interesting, because it's something that a lot of people are pointing to and aware of. Are we seeing the impacts of that currently, or is the current demand just off the back of what's naturally occurring in Australia? And the reason why I ask that is, net overseas migration, people coming into the country arguably aren't buying any property, but it certainly would have an impact on the rentals. So where is all of this demand coming from? Is there any data telling you about that scenario or that story?
So in terms of ABS housing lending data, that shows us a breakdown of owner-occupiers and investors. And even though first home buyers are the smallest segment of the mortgage market, they've shown the strongest bounce back, which is typical for a turning point in the housing market. You start to get a bit of an uplift in first home buyer activity. The net overseas migration piece historically is that around 85% of arrivals will be renters when they first get here. And the biggest destinations for overseas arrivals are places like Melbourne's inner suburbs, inner east, the western suburbs of Melbourne, where you're getting a lot more of the sprawl. Those were the top 3 destinations for net overseas migration in the calendar year, in the year to June 2022. These are some of the same areas we're seeing an incredible acceleration in rents, but I think at the margins, at least, you might be getting more purchasing decisions for people who just don't want to be bothered with that rental market. Now, mortgage costs are still far higher than rents and what rents have risen by, but it might be that that gap is getting close enough, or even just the competition and competitiveness in the rental market that might be filtering through to some more purchasing decisions. And of course, that 15% that would buy on arrival, perhaps they're a particularly wealthy migrant, or they're here for a permanent job and purchasing off the back of that. Even that 15% of a much larger net overseas migration pool is going to be driving some more purchases. But I think you're right. I think there is also that element of just the fact that transactions were so subdued during the recent downturn. Maybe there are just naturally more purchasing decisions happening as well.
Well, yeah, and even if it's just normal numbers of purchases, we are looking at extremely subdued supply numbers. What is it, about 15% under our 5-year averages? And it's just, you've been out there looking at the market, as have I. And I was saying in a recent conversation, you just get tired of looking at the same 15 or 20 properties. And it's hard to be out there as a purchaser, just looking at this consistently low levels of supply.
Oh, 100%. And you're quite right. So there is a deficit there. In the total listing space, we've counted about 134,000 properties for sale nationally. But as you say, even though that sounds like a big number, the historic 5-year average is 190,000. So there is really that supply deficit, as well as in the new construction space. The rate of new completions across the market has slowed. We're at about 43,000 dwellings completed in the December quarter of last year, a decade average of 47,000, but that decade average doesn't even reflect the surge in net overseas migration and increasing demand. So from both the construction perspective and also the listings perspective, just not enough is there on the market, and that's probably what's driving up the prices at the moment, despite really high interest rate settings.
So with that all being said, when buying property, obviously we're looking at the long term, and considering our consistently lower levels of supply, we've got a lot of first home buyers coming back into the market. We've got net overseas migration at record levels, and there's a lot of pent-up demand there. How long do you see these short-term influences impacting the market? And at what point could we see a shift to more normal numbers, or, kind of a crystal ball question? What, with the current influences in the market, how long do you see them impacting the Australian property market?
So in terms of the upward pressure on prices, the supply-demand piece is a tricky one. I would expect more new listings to come onto the market as interest rates come off. My reasoning behind that is when interest rates start to even just plateau or start to decline, you'll probably see repeat buyers or people who are looking to sell to upsize in particular will be more comfortable doing so. At the moment, I think there's a bit of hesitance, both because property prices are down relative from highs last year, but also people might want to not want to take on larger mortgages while interest rates are relatively high if they've already got somewhere to live. So I think it would be when we start to see a shift in interest rates that you'll get more established property sellers coming to market. The construction space, there's a lot stuck in the pipeline. And even when that does eventually come through, we're now seeing a shortfall in dwelling approvals. So I think that 2024, you could have quite a stark and persistent undersupply of properties as a result, and not a proportionate drop-off in net overseas migration. So I definitely see that upward pressure on the market extending into next year. In the short term, though, there may be, as you mentioned earlier, a little bit of steam taken out of the demand side off the back of potential further interest rate hikes. But yeah, next year, I think, is 2024 calendar year, is what I would guess to be the really robust upswing in Australia's housing market.
Interesting. So basically you're saying there's going to be consistent levels of low levels of supply, approval ratings are still low, no new constructions coming into the market. With the current levels of demand, we're going to see continued price growth. And the only change we might see in supply is off the back of there being price growth. So people will put their properties on the market, which will then open up just the new listings.
Yeah,
Okay.
I think that summarizes it pretty well. And look, you can never tell, right? We don't know what kind of headwinds are there. I think we probably haven't seen the full extent of mortgage rate increases on households and what that could do in terms of motivated selling. So that's definitely a risk to keep in mind, especially as the unemployment rate blows out this year. But just based on the supply demand piece, I think next calendar year could be a fairly robust upswing for the market.
Interesting. So talking about that, what parts of the market are you seeing performing the best and performing the worst currently?
At the moment, if we look at short-term growth rates, so say the past 3 months, it really is submarkets of Sydney that are leading an increase in value, particularly the high end of the market. So the top 25% of values are an increase of about 5.5%. In the 3 months to May. But we're also seeing a mix of relatively affordable markets in there as well, which is interesting because you don't usually see more regional rural markets in the top performance list when you're at the start of the upswing. So I think that could reflect in part, net overseas migration trends, where people who are living and working in regional rural Australia are staying here for a bit longer, and that could be putting more upward pressure on some of those regional community property markets. And Sydney just traditionally does lead cycles, so that's why that's kind of dominating top performance at the moment.
That's two things I just want to touch on there. So one on the regional markets, you just got me thinking, a lot of new overseas migrants coming into Australia actually have different visa requirements where they can't go to regional centres to accelerate their visas. So that could be that impact, and it may continue. The second thing, I just want to touch on this point because it's the data that you talk about very regularly at CoreLogic, but can you just quickly explain the 3 quartiles, or the bottom, middle, and the top, and then rough numbers around that?
Yeah, sure. So to give us a little bit of nuance on the market, we have our home value index, which covers the entire market value, but we also have our tiered indices. The high index is the top 25% of values across a region. The middle is the middle 50%, so from your 25th to 75th percentile value. And then the low is the bottom 25% of values. Now, historically, the high end of the market has had the best long-term performance and also has more volatility. So during a downturn, the high end will show deeper declines. During an upswing, it will peak out at a higher level as well. And then the middle and low end of the market tend to be slower, steadier performance. My guess is because there's not as much perhaps speculative activity, or they're not as sensitive to interest rate changes because there might be a little more flexibility in terms of supply. So your low end market values might be high density units or more urban sprawl areas where the supply is a little bit easier to deliver compared to your, eastern suburbs or northern beaches of Sydney, where new supply tends to be a bit more constrained. And I think that's where part of the volatility comes from as well. So, but at the moment, that high end of the market is really leading, particularly across Sydney. The only city where that's not the case would be Adelaide and Perth to an extent. You have really robust lower quartile performers there. Which could be a reflection of strong first home buyer demand or the appeal of those cities being the affordable segments.
And what do you see as the worst performers in Australia? What has been still sort of lagging behind?
Over the past 3 months, some of the lower performers have been some of the regional markets, to be honest. So the lowest submarket performer is Bendigo in regional Victoria. We've observed a decline of about 7% over the past quarter. Also, Bendigo's in there, Shepparton. I think that's probably more cyclical than anything else. Some of your regional markets tend to lag the timing of the cycles in the capital cities. So where we're starting to see, for example, Melbourne pick up, that could be where we will eventually see that trend follow in regional markets of Victoria. Obviously, the Victorian housing market has had some more unfavourable population trends through the pandemic, which could be factoring there as well. But I think, once you start to see that recovery trend being more established in the market, 3 months past the national trough in housing values, you can expect some kind of upswing or at least stabilizing in some of these worst performing markets longer term.
Interesting. So it is a cyclical thing that you're seeing. We have our market leaders. Sydney, top part of the market, typically moves first, and then you've got the laggards, for want of a better word, where, as the market matures, people start looking at these other areas, and then that's when they start to pick up as well. Very interesting stuff, Eliza. And, I understand that you're a busy lady, so I'll try and wrap up and have one last question out of you today. We always basically end on this. Every time we come around, it's good to hear a different tune. But what advice would you be giving new investors and homeowners so they don't fuck up their next purchase?
I guess keeping across the data trends is really important. So if you want to utilize some of that market information just to understand where you're at in terms of buyer and seller positions, you can always hit up the news and research page of CoreLogic. There's a lot of free resources available there to you. I think that when it comes to the Australian housing market, there is a pretty good bet there, particularly with the longer term supply and demand dynamics. So yeah, I would just wish everyone good luck and invite them to take a look at some of those free resources that we have available.
I would second that. I use CoreLogic data all the time. I'm not sponsored by CoreLogic. I just like talking to the company because they've got the best data on the market. And just for all of you investors out there, again, I want to second what Eliza said, that Australia is a safe bet. When you look at it relative to the other nations globally, we have performed very consistently over the past 30, 40, 50 years. and the market fundamentals have been very consistent and are pointing to a robust market. I mean, I want to just ask one last thing there. Do you see what sort of hidden risks are you sniffing or seeing? What kind of headwinds do you anticipate for the market for us more conservative-minded home buyers and investors? What's that that we're not seeing?
To be honest, I'm not seeing risks majorly manifest in the data yet, but I think one thing to be aware of is just the interest rate position. And maybe that does prompt a kind of change in your strategy and your approach to purchasing, because I think we are kind of beyond the structurally lower interest rates that we saw post-GFC and through much of the 2010s. So that's probably the biggest thing to keep in mind from a conservative perspective, is that, you know, doubling your money every few years is not really a guarantee. And it does just come back to that idea that property is a long-term game, and the fact that, you know, I think the interest rate scenario has changed.
Interesting. So we're probably not going back to a 1 or 2% interest rate for the foreseeable future. And if you're out there looking at real estate, you should be thinking about a 5 or a 6 in that rate for a long while and budget that into your equations. That's kind of what I'm hearing from you.
Yeah, that's right. That's right. I think there is the potential that sometimes we can be too quick to call the peak of inflation or the peak of rate hikes, and we're consistently seeing those upwardly revised. So I think just taking that into account and, you know, not expecting to be able to buy into a market, double your money in a couple of years and then get out again. I just don't think, I mean, all power to you, but it's not the same as a market that was buoyed by persistently lower interest rates and therefore higher asset values.
Understand. Well, thank you very much for your time today. It's always a pleasure catching up with you. There's plenty of interesting information for all of you that want the CoreLogic data. There's a lot of free resources out there for you to dive into, and some paid ones if you want to, which is excellent. Thank you again. Happy investing, happy house hunting, and I'll catch you all later.